Thank you, everybody, for joining. My name is Andrew Lucas. I'm the Director of Capital Markets, or Managing Director of Capital Markets here at Trion Properties. Just before we get started, a couple items. We will be taking questions at the end of this presentation. So if you do have any questions, which I'm sure you do, please drop them into the Q&A box, and we'll do our best to get to any and all questions at the conclusion of the webinar. Additionally, this is being recorded, and we're happy to circulate the recording to anybody that wants to rewatch it or miss something during the live presentation. And we were also happy to share the slides from the deck as well. And one of the things that you may notice as we go through this desk, some of the slides do have a lot of information on them. We'll do our best during this webinar to give you the general overview, talk in bullet points, but we know from previous experience, a lot of our investors do like to review the deck in depth. So that's why we did make them, pretty full with information. So the purpose of this offering is we allocated much of our Fund 3 capital in 2021 and 2022. The fund currently has 16 assets, 5 of which have needed a capital infusion. So the reality of the real estate market is right now, values have come down since the peaks in 2021 and 2022. Fortunately, the majority of our portfolio is holding up. The Fund 3 portfolio is holding up pretty strong, but there are some assets that do need a capital infusion. And the way our funds are structured is we don't have the ability to call capital from the fund investors. So we have called capital on certain deals from the direct investors, but we don't have the ability to call capital from the fund investors. We've had many of our Fund 3 investors reach out and express an interest in participating in the capital calls. And really, that is the nature of why we started this vehicle. So this vehicle is essentially a preferred equity vehicle that will allow Fund 3 investors to allocate to the deals that are requiring capital calls, and then it'll also offer outside investors the ability to participate. Fund 3 investors will have the right of first refusal to this investment. And then once that bucket is filled, we'll accept investments from outside investors. So again, my name is Andrew Lucas. We also have Max Sharkansky and Mitch Pascover with us. They're our 2 co-founders and managing partners. And then Adri Bailey and Felipe are here as well. There are 2 analysts that sit in the Miami office, and they can speak very in depth into the performance of the assets, underwriting metrics, financial projections, etc. So here's really a summary of this offering. It's not a massive offering. Essentially, we're seeking just under $10.8 million. This is a special contribution. Essentially preferred equity, and this will carry an 18% preferred return, and it will be senior to the common equity in the deals. The minimum investment for non-Fund 3 investors will be $50,000, and the minimum investment for Fund 3 investors will be their pro rata share based on the amount of this vehicle and their investment in Fund 3. So it will be less than the $50,000 for existing Fund 3 investors. And we do have a table at the end of this presentation, which will break down what that pro rata investment is. So, essentially, this is just a brief overview. And I know, again, there's a lot of text here, but the majority of the Fund 3 portfolio is holding in there. Right now, as you guys probably read on the news and you see through industry events and hearsay, it's a difficult real estate market. It's really the worst time to sell a deal in the last 14 years. And what our goal is in issuing capital calls and offering this new vehicle is really to be able to weather this storm and exit these properties in 2 to 3 years when conditions should be better than where they are right now. We don't want to fire sell our properties at this moment just because the end result would not be favorable. And really, there's many, obviously interest rates, which you guys all know of. That's one thing. Insurance costs have gone higher. Just general operational cost of operating properties have increased as well. So again, fortunately, the majority of the portfolio is in pretty strong position, but there are certain assets that do need a capital infusion to enable us to weather the storm. So we're not forced to sell in the worst real estate market in the past 14 years. So with that, I'm going to turn it over to Max. Max and Mitch, they'll discuss the next couple slides and just a brief overview on this slide. So this is essentially, where rents were projected to go in March of 2020. So we very closely follow Fed signaling and the forward-looking SOFR curve. And at that point in time, that yellow line at the bottom, that was where the SOFR curve was projecting rates would be. And the blue line is where they actually went. So I think that just is a good snapshot of how unforeseen the increase in interest rates were. So with that, I'll turn it over to Max and Mitch. Again, they are our two co-founders and managing partners.
Thanks, Andrew. So yes, as Andrew said, as you could see here, we were using common industry practice, which is to put the SOFR curve, it used to be the LIBOR curve, into your model. And this is how it was modeling. We would stress it, of course, to see a sensitivity analysis, but nobody was underwriting 550 basis point increase in 14 months, which is how we got into this position today. Next slide, please.
Oops, sorry.
So here we are. This is our Fund 3 portfolio. As you could see here, most of the assets, they're doing fine. It's a combination of fixed and floating rate debt. One of the strategies we had done prior to the rate shock was we were buying properties at a discount if we were able to assume their fixed rate debt, which allowed us A, to obviously buy properties at a discount, and B, take interest rate risk off the table and shift that discount to the seller. So we've got a number of properties in here, like the Cole, like the Felix, Las Palmas, where we assumed fixed rate debt. And then, you've got some in here that have capped floating rate debt, and just a few properties that have interest rate caps coming up, like Purse, like Magnolia, and that need capital infusions so we could buy the rate cap. Carla had an infrastructure issue with the plumbing, with the septic tank, and it's a very antiquated system where we had a very hard time getting parts. And Mitch and I put in millions of dollars of our own capital to keep the property going and to conduct the repairs. But we need to get some of that capital back, and we need to continue to make the repairs and buy the electrical panel and change out some of the pumps to get the property into a liquid saleable position, which will hopefully happen sometime in the next 12 to 18 months. And then on Pines, the seller was not entirely honest with us with the accounts receivable. And there were significantly more people not paying rent than we had anticipated. And as you may have heard, some of you may have heard, in the city of Atlanta, there was a quasi-eviction moratorium where you can only evict a certain amount of renters per unit per month. And it was very slow, and it was taking us 6 to 7 months to evict residents that weren't paying. So we did a combination of evictions and rent buyouts and cash for keys. We've evicted probably 15 to 20 people, 15 to 20 units, and we also bought out 20 to 25 units where we would waive their balances and occasionally give them $1,000 or $1,500, and we were able to turn a lot of those units. Let's go to the next slide.
Hold on, let's just stay here.
Sorry.
Go back to that one. I just want to add a couple more things. So, we've had a few investors that have called me and asked, why didn't we go fixed to begin with on these 4 deals? These deals were bought with a low in-place cap rate, and just like a construction loan, the lender basically, if they're giving you funds to renovate units, you can't get a fixed rate loan. So we went through and did an adjustable floating rate bridge loan. And then I just wanted to talk about term. We've had some investors ask me in terms of, like, are the loans coming up due? For example, the Pines property, it's actually a 5-year loan. It's a 4-year initial term with a 1-year extension. But the 4 deals highlighted in blue, we bought 2-year interest rate caps. So even though there's more term on the loan, the rate caps are due, and that's the main reason why we're raising money. Even though the loan's not due, we do have to buy a new 1-year interest rate SOFR cap. Okay, next slide. I just wanted to touch up on kind of 3 points I think people will have questions on. Why are you not able to refinance these 4 deals? Why do we have to go through and do a capital call or pref on? Given the fact that the properties are going through our business plan and we're increasing rents, we've obviously have caused some vacancy because we want to get to the units and spend money on renovations and increase rents. The properties are not stabilized. And as of right now, the way that Fannie and Freddie, the 2 main lenders on the fixed rate side, are underwriting deals, the rates currently are about 6%, give or take. There's a 30-year AM and a 125 cover, and they underwrite your in-place NOI, not your stabilized NOI. So the properties just don't size on a loan amount to refinance with a fixed rate execution. In terms of selling the properties, going back to Andrew's point, as of right now, I think people are hesitant to buy properties given where interest rates are. And if they do buy properties right now, they want to get a deep discount because rates are almost, call it 6%, give or take. So we've seen values come down. So it doesn't make sense to sell the property right now, A, because of where interest rates are, and B, the properties are still going through renovations. So most buyers are going to look at it and say, hey, I want a bigger discount because the property's not stabilized. Between those 2 points, it doesn't make sense to sell. And then 3, in terms of going out to a third-party lender for preferred equity, there are a number of preferred equity groups in the market right now providing third-party equity. You have an issue because, 1, most of the groups have a minimum debt yield test, anywhere from 6.5% to 7% on their money in place, which makes it difficult for these 4 properties. Number 2, most of these groups have raised large funds and they're looking to place around $5 million for each deal minimum. So that's pretty tough. And 3, the way we offered the 18% interest rate is pretty consistent with the market's asking for. Most of the preferred equity providers right now are quoting preferred equity at 15 to 16%. And then they have anywhere from 2 or 3% origination fees. So once you add up all the fees, you kind of get back to the 18% rate that we're offering to our investors. Okay.
Got it. Real quick, before we jump into the individual deals, I did miss one point when I opened up. So this offering, we should have the final docs back from our attorneys, hopefully in the next couple of days. We just sent back some brief comments to them. So once the offering is live and we are accepting commitments, you will receive via email an invite to the data room, which will have the PPM, subscription documents, a summary of the offering. And then should you want to move forward, you can just click the green subscribe text in the top right-hand screen, the top right-hand corner of the data room, and that will send you through to the subscription process. We utilize an investment management software, so you can execute the documents right there online. And then additionally, some of you that have invested in our fund vehicles previously, we would accept commitments and then call capital, in 30 or 60 days once we were under contract on a new acquisition. With this vehicle, there is the need to deploy the funds immediately. So once you commit, we will be calling capital immediately. So I just want to apologize. I should have mentioned that earlier. Max,
Okay.
do you want to discuss?
Yeah, sure. So the Carla, this is the property I mentioned earlier. This had a septic tank issue. The electric panel blew out. Several pumps blew out. We've been making repairs. We've had to do daily pumps, which, as you could see, down in the second bullet point of the shaded area, it was $5,000 to $15,000 per day to pump that out, and we had to do what we had to do. So we've got a couple $1 million of cost overruns. I actually got a note about 20 minutes ago that some of the parts on the electrical panel are finally in, and the electrical panel should be complete by the first week of January. So that has been about a 10 to 12 month wait. and it's finally done, or it's going to be done, and that will solve the problem. The pumps we've been changing along the way, and we've had minimal disturbances over the past 3-4 months. Most of these costs were incurred about a year ago. So we are rounding third base. We're almost done with it. We just need the remainder of the capital to bring this across the finish line. And we're doing some things here to try to figure out how to maximize more proceeds for the investors so that they can recover as much as possible. We're looking at possibly converting it to affordable. We're looking at renovating more units. We are, doing everything we can to maximize the return or the proceeds and get this property in a shape to sell, in a condition to sell. And as you could see here, if in the bottom right corner at 1201 Fulton Avenue capital stack, the preferred equity, the special contribution that we're raising here would be going subordinate. If you see on the right, the 2.5 million would be going not subordinate, excuse me. It would prime all the common equity, and you would have a significantly higher last dollar. So your 18% preferred return is in a great position. Next slide. All right, Purse, formerly known as Patterson Court, we rebranded as Purse Apartments. This was the property with a master lease to Disney. Disney gave us the keys back in May, so we've had no time really to do much. So here we are. We need to buy a rate cap. We need to finance some shortfalls over the next 12 months with some working capital, and we need to balance the CapEx budget. And we called some capital here. We got some capital from the investors who invested directly into the deal, but we need some capital from the fund investors as well. And as you can see here, you have a very strong basis. The last dollar was 120 million when we originally bought the deal, and here on the capital call, you'd be somewhere in the mid to high 80s. So, and assuming you fully fund the loan, you might hit 90, but that's assuming the loan gets fully funded. So great basis and fantastic risk return profile. Next slide. Pines.
Before we move
Go
on,
ahead.
Max.
Yep.
Just a couple more notes on Purse. I would also note that this property has a really bright operational future here. So one of the things to note about it is just that because we haven't had time to execute on the business plan here, the rents have been and are significantly below market. When we got this property back, you had rents closer to $1,300 to $1,500 on average. Your recent leases here are close to $1,900, and market rents are even higher. So there's significant room on the top line for this property, and we haven't even begun our renovations yet. So Orlando is a great place to be, and the special contribution here is, I think, really safe in that as you look to the top right corner of this slide, you can see the what's labeled as the break-even cap rate. That's actually the cap rate that we would need to sell at in order to get back every single dollar of the pref plus the accrual. So that's all of your capital plus the 18% return. As long as we sell at a cap rate tighter than almost 7%, all of your new investment will be returned to you. And that's true for this chart on every single one of these deals. We can move to Pines. So Pines is our property in Atlanta, constructed in 1973. This property we purchased, the seller was less than forthcoming about the bad debt at the property, and there were significant issues getting the non-paying residents out because the county was less than cooperative. So at one point it was taking 6 to 9 months to evict. That has improved substantially, but we still took a hit in terms of vacancy here. and our vacancy spiked to almost 35% at one point, which burned through a lot of the extra reserves that we had in to pay for interest here at the property. It's on the way back, or at least the property is improving. We have about 24 move-ins over the next 3 to 4 weeks at this property. So we're rapidly getting to a position where this property is stabilized. We think it'll be stabilized by the end of the next quarter. But to get there, we're looking for a cash flow bridge or a cash bridge of $2 million in reserves to cover shortfalls for the next 12 months, plus about a 70% buffer on top of what we think we need to cover anything additional that comes up, or if we have any additional problems that take longer than we expect to take care of. And if we overperform, because we've been pretty conservative on the pro forma, there will also be some cash available to help pay for the replacement of the upcoming rate cap. Next slide, Felipe, you can take Magnolia.
Thank you, Adri. So the Magnolia, like all these properties, is in need of a capital infusion. We bought Magnolia just under 2 years ago now, coming up on 2 years. It's December. This is a deal that we have fully executed on our business plan, and our top line income is actually exceeding our
Felipe, there's a little bit of an audio problem.
Yeah, there you go.
There's an audio problem.
You're talking on 2 Zooms. Mute one.
Is this better?
Yep.
Much better. Yep.
Okay. Apologies for that, everybody. So as I was saying, we're hitting the 2-year mark now of owning the Magnolia. We've actually exceeded our pro forma figures in terms of income and revenue here. Our market rents for unrenovated units have gone up about 20%, which is about a $230 delta just in natural loss to lease. And at the same time, we're getting another $256 increase over our renovations here. So these numbers are better than our underwritten numbers at the acquisition, but this property, I feel more so than the others, has been adversely affected by the market we find ourselves in, not only in capital markets, but the insurance market as well. At the time of acquisition, our insurance was $320,000 per year. And after the wake of Hurricane Ian and the lack of reinsurers in East Coast markets across the United States, our insurance more than doubled to $770,000 over the last year. All of this while our debt service also doubled due to the Federal Reserve increasing interest rates. So all of this is to say, despite our exceeding of pro forma numbers, insurance and debt has really wiped the cash here. But that's not to say we're not making moves to remediate the issues here. We're actually bundling Magnolia with another one of our East Coast properties in Orlando and getting an insurance premium this coming year, starting in January, of $300,000 annualized January through April. And then after hurricane season, will level off and even out to about $550,000, which is about a $250,000 savings over the last year. And as capital markets improve, obviously, our interest rate payments will be lower as well. So as you can see on the bottom, the capital is going to be used for the purchase of a new rate cap, establish some reserves, and pay off some existing preferred equity that was put in through another fund vehicle. The preferred equity here, the minimum price to be made completely whole at sale would be about $50 million, and Magnolia currently has a higher value than that. So the implied cap rate at sale would be about 7%, like the other deals. Next. So this table here is basically a summary of the valuations of the properties today compared to where we expect them to be and where we would need them to be for you all to be made whole on this preferred investment. So the bottom row, the minimum value needed to cover special contribution return, this is the minimum sale value needed to be made whole on whatever's contributed to this fund. And I would like for you all to compare that to the estimated value today in the markets we find ourselves in, with, capital markets being completely blown out. Interest rates right now, as we all know, have been unprecedentedly increased, and many of the investment banks across the United States, such as Goldman Sachs, UBS, are predicting rate cuts over the next year ranging from 2.75% to 1%. So obviously, as these interest rates start to be cut, capital markets will improve, liquidity will reach the market, and these valuations will go up. All of this is going to happen while we continue to execute on our business plan, renovate units, increase NOI, stabilize properties, like in the case of Pines, which is really adversely affecting the value. And there definitely is a plan to get to these stabilized figures. We're very confident in our assumptions, but we do just need the capital infusion to be able to get the time to execute on these plans.
Yeah, let me just add two things here, Felipe, and Max could add as well. But if you look at some of these properties, like we talked about, I think interest rates are having a big effect, and then insurance in the Southeast. But if you look at, for example, let's start at Patterson, which is Purse. The NOI today is called 4.2, and a projected NOI at sale 6.2. This property we bought was master leased to Disney, and we got the keys back in May from Disney. They were leased under market to all Disney employees at the property, and we're getting anywhere from like Adri mentioned, a $500 to $600 increase on units just mark to market without even renovating. So there's a clear path to get to the projected NOI once we start renovating the units. And then in terms of Pines, I mean, what Max said earlier, that property had a huge delinquency issue. We've got rid of a number of the tenants that were not paying rent, and now we're leasing on new assumptions with tenants in terms of a stronger debt to income ratio, so they're able to lease the units based on certain kind of qualifications. So we don't anticipate to have these kind of delinquencies going forward. But I think overall the picture here is the properties are not really having an operational issue in terms of achieving the rents that we had in our pro forma. They were really hit by either insurance issues in the Southeast, which no one anticipated, or interest rates.
And just to add to that point, Mitch, and provide some context on the Pines, since we've implemented this program, Snapped, which is basically an income verification service for new tenants at the property, 27 of our last 28 move-ins at the Pines are completely current on their rent, which is a great improvement over what we inherited. So we are making strides. There is verifiable steps that we've been taking, but it's just a matter, again, of getting that runway.
I think there's also some really good, I think the future looks brighter than today. If you kind of look at this portfolio of assets, these are assets that need a bridge to a better future that were kind of caught by the current macroeconomic environment midstream. But I think there are some catalysts to get to a better future that are really, really bright. If you look at where interest rates seem to be going, the Fed has paused moving interest rates up. Most of the investment banks who hire some very smart people believe that interest rates are on their way down. Those markets where we've seen weakening in the rent market has been due to supply growth. New supply is being delivered right now, but going forward, supply growth seems to be down across the nation as the currently high interest rates have made it impossible for new projects to get started. So you basically have a flattening of the supply curve in most of the markets that we're operating in the next 2 to 3 years when we expect to sell these properties. And you have a downward sloping interest rate curve in the future, which should mean that we should be able to sell these properties into markets with very little supply, with more capital available, where buyers can come in with great interest rates and pay more for these properties. And that's really good because selling these properties right now is probably the worst thing you could possibly do. But So I think that overall, those kind of things help us feel good about the future path of these properties, and that these additional funds will get us to that brighter future.
To add on that, not only is valuation a function of interest rates coming down, it's also a function of liquidity in the system. And Max, Mitch, and I were in New York about a month ago when we met with probably 12 to 13 different real estate private equity funds. And they all have, hundreds of millions to billions of dollars raised. And as we sit today, they are all on the sidelines. They're not deploying capital. At some point, and we don't have a crystal ball, I wish we did, but that capital is going to come into the market, and that's going to start pushing cap rates down and cap rates up. Hopefully it's Q1 or Q2. We don't know when that will be, but as Felipe and everybody has mentioned, we're bridging that gap until it occurs. And those big Wall Street firms, they tend to move in herd mentality. So when one of them starts investing, all of them will start investing, and that'll kind of kickstart the liquidity in the real estate market, which will help things improve.
Okay, I think this next slide is, we just wanted to add a quick summary of kind of what the fund is trying to do. As Adri mentioned earlier, the total amount that we need to raise is just over 15 million. As of right now, individual investors that invested in these deals have sent in 4,275,000. So we're looking to raise the balance, which is just under $11 million. The return we mentioned is going to be an 18% return, which is a simple interest per year that's going to accrue. And then in terms of priority of payment, this preferred equity obviously is senior to the common equity, but we get paid back after the senior lender gets paid back. So it'd be once we sell the property or refinance, obviously the existing senior lender gets paid back first, and then this preferred equity vehicle will get paid back second. And then in terms of minimums, it's a $50,000 minimum investment for new investors. And then investors that are invested in Fund 4, the minimum would be their pro rata share of their Fund 3 investment.
Yes, just to clarify, it is Fund 3. Great. I'll move on. And then here's, in setting out this email, we did get some questions, and obviously many people have many questions, but this is just kind of a few of the questions that we were asked by multiple investors. We just touched on how much was raised from the capital calls, about, I believe it was 4.2 million. Max, do you want to take these next questions?
Sure. Andrew went ahead and answered number 1. Will you return the funds if you don't meet your target? No, we will not, because there are other solutions if we fall short. We can get additional equity from other sources. We can reprioritize some of our costs. Just because we don't meet our exact target doesn't necessarily mean that the whole thing falls apart. If one of the properties cannot pay the 18% on the money that goes into it, will other properties make up the difference? Yes, because it's crossed, just like a fund investing into common. So if one property does not do well and other properties do well, and we can, and it does have the ample cash flow from a sale or a refi to pay the 18, it'll pay the 18. Why are you raising the money from this fund rather than a third party pref investor, pref being preferred equity? We are raising the money from this fund because we'll have complete control. The cost will be better. There's better alignment. We won't have somebody looking over our shoulder to make sure that we sell in a certain amount of time or meet certain hurdles in a certain amount of time. We'll have complete control end to end, and we can control when we refi, when we sell, how we renovate, and ultimately do what's best for the asset and for the investment.
And we also had a number of investors that came to us and said, hey, instead of going to a third-party preferred equity group, we would like to put the money at that interest rate to protect our investment. So we've had a number of investors ask us that.
Great. Thanks, Mitch. That's a good point. Are there any upcoming capital needs, or is this a one and done? We're hoping this is a one and done. I don't want to put my foot in my mouth yet again, because We had investors reach out to us earlier in the year and say, hey, are there going to be capital calls? And I said, I doubt it. So here we are. And I don't want to make that same promise again. So we're hoping this is a one and done. There are a couple properties next year that may have some small calls, although again, we're trying to hedge and avoid that, but I'm hoping it's a one and done. Why are you only budgeting for 1-year rate caps? We are budgeting for 1-year rate caps because right now a 2-year cap is extraordinarily expensive given where we are in the interest rate cycle. It is widely the consensus that we are right now at the top of the market with interest rates. They are not going to get any higher, and they will probably start easing within the next year, which means rate caps won't get any more expensive. So we're better off waiting and buying a second rate cap in a year from now, or refinance, or not buying a cap at all, and either refinancing or selling the properties. Next slide.
So I'll take this slide. So this is essentially a summary of the investment amounts of our Fund 3 investors. So if you, for example, invested $100,000 in Fund 3, the pro rata share of your capital call would be $27,387. So again, if you're $100,000 in Fund 3, your minimum investment would be $27,387. You do have the ability to overfund your pro rata share. And then you can see the chart. If you invested $50,000, it's half of that amount, $13,694. We did receive a question. We're not a Q&A yet, but we did have a direct investor in one of these deals ask if they are subject to the $50,000 minimum. And the answer is yes, you do. If you're a direct investor in one of these deals, but not a fund investor, you have the ability to meet your pro rata share of the capital call directly into that asset. But for this vehicle, this is a separate vehicle. So if you are not a Fund 3 investor, the minimum investment will be $50,000. Questions. And then before we get to questions, we do have oops, sorry. Oh man, I apologize. I just got kicked out of the slideshow. There we go. We do have an appendix with some additional information. But then let's get to Q&A. So is it smart to buy in Florida now with interest costs and insurance costs and higher taxes?
Let me take that one. Well, we're getting to the end of the hour, and I want to be mindful of everyone's time. So we'll choose the most pertinent questions. I think it's a great time to buy in Florida, especially because of interest rate costs, because again, the consensus is they're not going higher. I had a call and a meeting actually with Marsh last week, and we talked to insurance people there almost daily actually right now, because we're in a deal in Florida that we're trying to buy, and the consensus is rates aren't getting much higher over the next year. It is plateauing right now, and come 25, 26, 27, rates will probably go down. So insurance premiums right now we think it's at a peak, and it's actually upside to buy a property right now with today's insurance costs, because it ultimately hurts the seller, not the buyer, and it's just upside for the buyer. Does the formula you have used for years work in this environment? Meaning, if we renovate, can we raise rates 20, 30, 40%? Or does that not work in this environment? No, it still works. Rents have softened a little bit. Rents have softened a little bit. But there is still tremendous upside. A lot of our properties still have a renovation premium. So we are continuing to renovate. How aggressive is the 6.92 exit cap? Do you guys see caps expanding any higher into 7% range? How does that look from a sensitivity perspective? I think we're fine. And as we mentioned earlier, we're not going to be selling into this environment. We're selling into an environment probably in 25, 26, 27 when cap rates come down.
I think what he's referring to, sorry, Max, for the 692 cap, and that question is the break even. Basically, that's the cap rate, which is a very high cap rate, exit cap rate that we would need to sell at to make your investment whole into this vehicle. So basically that's just to show like it would need to be sold at a very conservative price to pay back the 18% return that you made here.
Yep.
To pay back the senior lender and to pay back the preferred equity plus the accrual. That's what it ends up.
That's a very, that's a very, very conservative number. Are you charging fees on this fund? If so, what are the fees? No, there are 0 fees. So the entirety of the preferred return goes to the investors. And that's actually a great question because it's not going to be exactly an 18. There are some small expenses like legal, tax preparation, formation documents. So it'll wind up being somewhere in the 17s.
But there is no fee promote or any kind of incentive to Trion for this fund, correct?
Just some organizational expenses. Is this preferred rate fair to existing investors? It is fair because it is expected for them to invest and make their pro rata contribution.
They were offered the same deal, and failure to do so would result in having to liquidate the deals in a market that would be far more dilutive than this 18%. So very fair.
And it's comparable to what the market right now is quoting on preferred equity. If we went out to a third party group and we got a preferred equity at 16 and 2-3 points going in or out total, you end up getting to the same number. So that's just kind of where the market is pricing preferred equity today.
As the current interest rates were not anticipated, please speak to what happens if things do not quote unquote improve. Interest rates remain high or increase and insurance costs continue to increase over time. Again, these are all possibilities. They're remote. It's very unlikely that interest rates continue to rise, and it's unlikely that insurance premiums continue to rise much. By the way, insurance premiums are tied to interest rates as well, because insurance carriers are not compelled to put out as much money when interest rates are high because they could put their float into short-term treasuries and money market accounts, which yield 5.5%. And once rates go down, they're going to be forced to write more policies and take more risk. It's also widely assumed that more interest rate carriers will come back into the market because the profit margins are just massive right now. And a lot of that's going to adjust.
It's also worth noting on the interest rate speculation that the last 2 Fed meetings have marked the first consecutive Fed meetings where interest rates have been untouched since 2021. On top of that, we have to ask ourselves why is the Fed raising interest rates to begin with? And it's to combat inflation. Inflation's at its lowest level since 2021, before the big boom post-COVID, and also employment numbers are down. So these are all the metrics that the Fed uses in determining whether or not they should raise interest rates. And now we're starting to see in the larger cycle that their raise in interest rates is being effective, and it's more likely than not, given with the last 2 Fed meetings, that they're going to continue to pause and even do some quantitative easing over the next year. You could also see this in your stock portfolio, as you've seen through November, a 10% rise in the S&P 500. So it's not just our speculation. Again, it's all investment banks and the market as a whole.
Okay, next question. The $5 million called from sidecar investors goes in as common equity, or is this the same preferred? Same preferred. It would obviously it wouldn't be fair to have sidecar investors send in $5 million and go in common. So it gets treated the same way as preferred equity. And then the follow-up question is, why can't call equity from Fund 3 investors? That's just in our documents, in our fund documents, that we're not able to do capital call for fund investors, only for individual investors. So we're not able to call capital. Next question, when are you planning on exiting the properties? Does the timing line up with the terms of the new rate caps you are buying? So no, we're going ahead and buying 1-year rate caps on the properties. The properties will not be in a position to sell in 12 months from now. They could be in a position based on the income at that time to refinance with Fannie or Freddie, so we could refinance the debt. But we're not going to sell these assets in 12 months. So I think at that time, we'll look where interest rates are, and at that we'll decide at that point, do we want to move forward and refinance with a fixed rate execution? And we could always buy another rate cap, given the fact that we believe interest rates will come down. We think the rate caps will be cheaper, so it doesn't make sense for us to go ahead and buy a 2 or 3 rate cap, interest rate cap today. Next question, how will this raise affect targeted equity returns for Fund 3, assuming current expected? Oh, that question just went sideways.
Oh, sorry.
Go
How will
ahead.
this raise affect target equity returns for Fund 3, assuming current expecting timing of sales and refis?
I mean, look, the returns are going to be down. I'm going to be honest with you and let you guys know, obviously returns are going to be lower than we anticipated, given the fact that we have to do a capital call and put 18% preferred equity on the deals. 2, obviously we've been hit by with interest rates being higher than we anticipated. And 3, insurance costs are higher. So really the way I look at it, and we're putting, Max and Mitch, both of us are putting money in the deals as well, is we're looking at it, it's all about preservation of capital. We don't think it makes any sense to sell these assets in this marketplace. So we're telling our investors and ourselves that, hey, let's put money in today, buy interest rate caps, get us through this tough time, keep on executing our business plan, and then sell the asset in 2 or 3 years from now.
I would also add to Mitch's point that the way we've underwritten these deals, we took a look at each one of these deals. We've been laser focused on asset management and asked the question, hey, what do these deals look like today? And what do we need to do with these deals to get these to break even and return everybody's capital to them? But we've made some very conservative estimates on how fast we can do renovations, where our operating expenses will be, what the rate environment will look like. But all of those things can kind of change and they can all go together, right? If your interest rates come down, your cost of insurance can come down, more capital can enter the market, which can raise your sale price. So those things can all kind of move in your favor all at one time, but we've been very conservative on the underwriting here. And we've put the special contribution into a position in the capital stack where it's probably as safe as it could be outside of being the senior lender, right? You're right behind the senior loan. You're in front of the common equity. You would have to sell the property and wipe out all of the common equity in order to not get your capital back for the special contribution and your accrued return. So what we really try to do here is to incentivize as much as possible for our own investors to come in and put some additional equity into these deals to get them that bridge to the future. But we've also been very conservative in our underwriting. And I personally think that there's a little bit more upside for the common equity here. But what's most important is that we protect capital by putting in a little bit of extra money to get to the other side of the current storm.
We've gotten a couple of questions on Fund 2. I know this is a Fund 3 specific webinar, but it's likely we'll be offering a similar vehicle for Fund 2. Just the vintage of Fund 2, we allocated much of the capital 2019, 2020 post-COVID. So it isn't as the capital calls required from those funds are much less than Fund 3. So yes, it's likely there will be a similar vehicle, but as we sit today, Fund 3 is our priority.
Also, a few questions on how much, whether there's going to be any payments at all along the way. On the 18%, yes, there should be as soon as we get into a rate cutting cycle and we continue to renovate and increase NOI. We'll be able to refinance and we'll be into a cash flowing position, and we'll be selling along the way. Keep in mind, this is across many assets. So as we're cash flowing, as we're selling, you'll be getting paid along the way, as opposed to 3, 4, 5 years out. Let's do a couple more here.
One thing I think we should clarify, and again, we don't have the finalized fund docs, but and Max, earlier we suggested that the fund will be crossed up, but because these are individual deals, I believe, this pref entity would not be crossed up. Is that correct? Because if, say, heaven forbid, this is a unlikely scenario, but if one deal was to be taken back from the bank, we wouldn't be able to take common equity from a separate deal to meet this preferred return. Is that correct? Or
No, yeah, correct. Well, correct. Common equity would not pay for that, but other preferred equity in this vehicle and other deals would.
got it. Okay.
How long do you anticipate Fund 3 NOI distributions to be delayed? Will there be any current payments on the 18% preferred, which we or will it accrue? Does it compound? It compounds annually, and as I mentioned earlier, we do expect to start paying it as soon as we get into a cash flowing position. And we're already looking at refinancing some assets in our portfolio with interest rates starting to ease a little bit. Bonds are rallying, and we think we'll be in a position at some point next year to start refinancing and selling some properties. I mean, I think that covers a lot. A lot of these questions are redundant.
Fund 3 is about 39.5 million in total. It's mostly invested. We had about $500,000 in reserves, which unfortunately wasn't enough to meet the obligations of the pro rata share of Fund 3's capital call, which is why we're creating this vehicle, because we don't have the ability to call funds from Fund 3 investors.
Here's a good question. Those invested through CrowdStreet, should we invest direct? Those invested through CrowdStreet will simply subscribe directly through Trion for this portion. Yes, just subscribe directly through us, because this is the equivalent of a capital call. This is not a new investment. I mean, I think that pretty much covers it. If you have any other questions, feel free to email us directly, and we'll answer them as fast as we can. Thank you, everybody, for your time. There were a lot of people on this webinar. Hopefully, it's a very successful raise, and ultimately will be successful investments. Of course, this is not something that we expected, and we hope that in the next, I would say, 1 to 3 years, we're able to exit these successfully. Team, any other comments?
No, thank you all for joining.
No.
And again, just from a logistics standpoint, as soon as we have the documents finalized and build out the investor portal, you'll receive an email with a link to the recording of this webinar, and then also a link to the data room. So then once you access the data room, you can access the PPM, subscription documents, etc. We'll have a recording of the webinar in the data room, other summary information, and then should you want to invest, click the green subscribe text in the top right-hand side of the screen, and that will take you to the place where you can fill out the subscription documents electronically. And again, this is different from our previous funds where we would accept commitments and then call capital when we're under contract on a deal. We will ask for your funds as soon as you commit. Thank you very much. We appreciate it, everybody.